Investors, stop what you're doing and listen up. 2023 is about to get a whole lot uglier than we all thought, and while planning for the best, be well prepared for the worst, because Jerome Powell's recent hawkish statements to all the unfavorable economic data sets sparked market uncertainty, which is making for a lot of market volatility. Now, if you're brand new here, I'm Ari, your value and dividend investor on YouTube, breaking down our economic backdrop, gifting you with stock ideas, and from time to time, interviewing other masters of the market. As for today's video, a quick update on my personal account, the Jerome Powell commentary that you need to be aware of if you plan on investing in 2023, as well as 5 dividend stocks that you can buy right now and simply hold for solid returns as the market wavers. Before we dive in, tap on that thumbs up button, consider it your entry ticket, and subscribe to the channel to join me on the journey through the ups and the downs of all of this market volatility. Now, investors, let's dive right in. So to start, a quick account update to show you that you're certainly not alone if your account has been taking a hit, given mine certainly did, as it sits at $105,790.70, which is down by another $1,000 or so from this time last week. Now, honestly, I'm not worried for 2 reasons. One, I expected the volatility, which I shared last week, and moreover, because my portfolio is actually built to withstand market downturns and prevail over the long term. But I want to talk about our economic backdrop briefly, because in knowing the macros, we can begin to prepare and have a better understanding of where and how to invest. And if there were any key market moving events last week, one was definitely Powell's Congressional update, where he shed light onto the Federal Reserve's plan of attack moving forward. Now, before I show you the clip, a warning that it's 2 minutes or so, but I promise it's worth your time and your listen if you're looking to be an informed investor. With that, have a listen.
My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
I
know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right, let me put it another way, okay? The economists did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now, that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to.
The first takeaway is that the Federal Reserve will continue to increase interest rates, and they're likely to become even more hawkish as they do. So my bet is a 50 basis point rate hike is coming out next. But the second takeaway, when Powell was grilled by Senator Kennedy of Louisiana, and you heard firsthand here, Powell essentially said layoffs will be an outcome of raising interest rates. And all I'm saying, once again, is pain is on the way. And in my opinion, we're going to need to see layoffs across sectors to really cool this economy down and shake up this robust labor market, which has remained as strong as ever right down to our last employment report as of this past Friday. However, where does this all leave us? Well, playing some defense with companies that are well capitalized with strong management teams and reputable brand names, which leads me to the very first dividend stock that I want to break down today, granting investors some true insurance on their hard-earned dollar. We have Aflac, ticker symbol AFL, which actually since its founding in 1955 has become the largest supplemental health and life insurance provider within the United States, and even operating a segment overseas with Aflac Japan, ultimately amassing a market capitalization of over $45 billion. And as this economic environment becomes even more uncertain, we can, or at least I'm going to be betting confidently on an insurance company like Aflac, given their reliable business model and, well, just a societal need to feel safe and insured. Now, Aflac has had a relatively low PE ratio for some time, hovering around 10.2 as we speak, but I have been waiting for their share price to actually slide to, well, which it recently has, with Aflac currently trading for $66 per share, making for a 7% decline year to date. But if fear in the market continues to build, I only foresee upside, and so too do analysts, with a forecasted share price of $72 per share. That's just about 8.8% worth of upside, and until Aflac rebounds, the best part is Aflac's dividend and insurance in its own right, coming in above the sector average with a dividend yield at 2.37% worth of a dividend yield. Next up, a powerhouse within the utility sector, Eversource Energy, ticker symbol ES, which is a Fortune 500 electric services provider engaged in the transmission and distribution of electricity, as well as natural gas and regulated water utilities. And after a merger with Northeast Utilities, this utility behemoth now has over 4,270 miles of electric lines and over 6,400 miles of natural gas pipeline, serving over 4 million customers in Massachusetts, Connecticut, and New Hampshire. All in, Eversource has amassed a whopping $25.81 billion market capitalization, yet has yet to become immune to shockwaves of volatility, whereas we see their share price down more than 10% on the year, with that share price of theirs currently sitting at roughly $74 per share, and a PE ratio that followed suit on that decline, coming in at 18.3. However, this is a utility investment, meaning unless we have 3 states worth of customers willing to go back to the Stone Ages without electricity, a rebound is in sights. And a matter of fact, some of smart money's most notable investors, from Ray Dalio to Mario Gavelli and Ken Fisher, already ahead of the masses here, beginning to scoop up more shares worth of Eversource, while analysts also give a very favorable outlook for Eversource's future, coming in with their forecasted share price of $89.67, making for nearly 20% worth of upside. And of course, there's no better way to energize your portfolio than with the stock delivering through on an above sector average dividend, with Evercore's yield coming up to 3.37%. Moving right along to our third dividend stock, it's a medical device leader, and no, it's not Johnson & Johnson, though I will share that I officially hit my goal of 100 shares worth of Johnson & Johnson, but more on that in another video. I want to talk about Medtronic, ticker symbol MDT, which is strictly focused on delivering revolutionary medical technology to the market. It was founded back in 1949 and has come to operate across 4 segments, from cardiac and vascular technologies to minimally invasive and diabetes technologies. That has allowed Medtronic to amass over $106 billion worth of a market capitalization. Now, this is not the first time I've mentioned Medtronic on my channel, and I will say I think this investment is often overlooked or just not as well known for whatever reason within the industry. However, it's incredibly reliable, but it has seen plenty of struggles over the last few years, whether it has been supply chain matters or more recently clients scaling back their spending, which has reflected in Medtronic's share price fluctuations. It's currently slid to $78 per share, down over 11% on the year, and just within the past week or so took a hit from all the nil economic projections for the remainder of 2023. Nonetheless, in time, Medtronic is going to be on the comeback, delivering profitable returns to shareholders. Now, we already see hedge funds loading up on Medtronic, but we also have analysts who are full of optimism. They're coming in with a forecast of $93.30 per share. That's nearly 20% worth of upside. And because it pays to be patient, Medtronic will also be paying an above sector average dividend with their 3.26% dividend yield. Up next, a global investment firm that I cannot get enough of, so forgive me if you're hearing me mention it yet again, but hey, I'm not here for entertainment, but rather stock ideas. Let's quickly dive into T. Rowe Price, ticker symbol TROW, offering services to individuals or larger scale institutions with over $1.35 trillion worth of assets under management. And if you can believe it, most of those assets are within the tech-heavy NASDAQ. So as you can imagine, this $24.97 billion market capitalized financial industry leader remains down on the year by nearly 8%, and although it popped to over $120 not too long ago, it slid recently, whereas its share price is $112 per share, given the uncertainties of 2023. But hear me now, T. Rowe could certainly see further declines depending on economic data sets to come and investor sentiment. However, it's not too shabby with a PE ratio now at 16.6, which is why smart money has been pouring millions into T. Rowe Price, and I only foresee more hedge funds investing into T. Rowe as the market gets closer to a bull market entry, which will also take time, but it always pays to be patient when it comes to T. Rowe Price. I'm loving this dividend of theirs, coming in well above the sector average at 4.31% worth of a dividend yield. And finally, investors, if you're looking to play it ultra safe and just have an incredibly simple investment approach, I cannot say enough how lucrative ETFs and indexes can be. Now, my personal fund of choice is VTI, but today, given a recent interest of mine, I want to talk about the Schwab US Dividend ETF, ticker symbol SCHD. Given I am really forecasting gloom and doom in 2023, and call me a pessimist, but I have been calling every negative market reaction recently. No, I'm not a market wizard of any sort, nor can I predict the future, but I am just listening to the Federal Reserve and understanding fighting the Fed is a battle lost 10 out of 10 times. So with an extremely low beta of 0.74, SCHD is, in my opinion, ultra safe with 101 total holdings, with each of the companies within the fund meeting criteria of mine, like strong leadership, quality brand names, and clean balance sheets. Of course, this is a dividend ETF, so you'll reap a quality dividend averaging 3.46% worth of a dividend yield. Now, if I jump into an advanced chart to compare SCHD to, say, VTI, well, we see SCHD under our current economic environment is the clear winner, which is why I'm sure there has been an increased amount of hedge fund activity padding up their portfolios with the fund. And at the end of the day, sometimes investing is about a stronger defense as opposed to having the best offense. Anyhow, there you have it, investors, the 5 dividend stocks that I'm sharing with you this week to add to your stock watch list. And should Aflac, Eversource, Medtronic, T. Rowe Price, or SCHD be suitable for your portfolio, be my guest to invest into them. Keep in mind, I am not, just as no YouTuber should be, your end-all, be-all investment advisor, so always do your own due diligence. But as always, let me know your thoughts thereafter by dropping a comment down below. And oh, if you haven't already, tap on that thumbs up button and join me on the journey by subscribing. Now, investors, I will see you all in the next video.